Everybody, this is Intermediate Accounting 17th edition video solution walkthrough for problem 1413 from the book Intermediate Accounting 17th edition. Authors Don Cuso, Jerry Weingen, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 through 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, so let's take a look at problem 1413. So Hoover Corporation is having financial difficulty and therefore has asked Frontenac National Bank to restructure its $5 million note outstanding. The present note has 3 years remaining and pays a current rate of interest of 10%. The present market rate for a loan of this nature is 12%. The note was issued at its face value. The following are 4 independent situations. Prepare the journal entry that Havoc and Frontenac National Bank would make for each of these restructuring. Frontenac National Bank agrees to take an equity interest in Hoover by accepting common stock valued at $3.7 million in exchange for relinquishing its claim on the note. The common stock has a par value of $1.7 million. Okay, so right over here, if I am Hoover, okay, so Hoover has a note payable outstanding of $5 million. So if I'm Hoover, for part A, Hoover is going to be debiting notes payable for $5 million. And this is what absolutely drives me bananas. And the author said that they would change it for the 19th edition, but to me, this is just insane. So I'm going to have common stock at par. The common stock at par is 1.7 million. You would never do this in real life. You would do par value as a fraction of a penny. And just to kind of show this again, if you go to any publicly traded company, with the exception of Buffett's company, Berkshire Hathaway, that is a $5, right over here, 0.0833 par value. You never use a high dollar par value, and it's because there's an obligation to the corporation in the event that if a shareholder buys stock below par from a corporation, they owe the corporation the difference between what they paid in par. That's why you show par at a fraction of a penny, or something very low. So I've got common stock at par, additional paid in capital common stock. This is going to be 2 million. What is additional paid in capital? It's the difference between the value minus the par. Or 2 million. Okay, and then over here, the difference is going to be a gain on restructuring of debt. Okay, this is what we need to do to balance to get this to work. Okay, so that's for Hoover. So what about FNB? So FNB is receiving stock. So they're receiving 3.7 million. And they're also writing off their note receivable. Their note receivable was 5 million. So over here, we're going to go ahead and debit the allowance for doubtful accounts. And I've shown this on a couple other videos, but the allowance for doubtful accounts, when you're in the business of a bank and you're loaning out money, what is effectively going to happen is that when you do the allowance for doubtful accounts, when you're doing a write-off of a receivable, you debit the ADA and you're going to credit the receivable itself. What's going to happen is that in order to balance your allowance for doubtful accounts, you're going to have a beginning and then an ending balance. So when you credit the ADA, you're going to be debiting bad debt expense. And this is essentially to go through and record the loss. Okay. So part B. Frontenac agrees to accept land in exchange for relinquishing its claim on the note. The land has a book value of 3.25 million and a fair value of 4 million. So for Halvor, so what Halvor is going to be doing over here, Halvor is going to be, of course, they're going to be debiting their note payable of 5 million. Okay. So Halvor has a couple things happening here, right? So we're going to have land of 3,250,000. With Halvor, though, right, we don't want to say that the rest of it is a gain on debt restructuring or relinquishment of debt. But over here, what we're going to do is we're going to say gain on sale of land. And this is going to be 4 million minus the 3,250,000. Okay. Now, what happens now here is that the rest of this becomes a gain on debt restructuring. And this is going to be $1 million. Okay. So let's go ahead and do the one for FMB. This is going to look somewhat familiar. So for FMB, now I'm going to be getting land. My land is at 4 million. I'm still writing off my note receivable, and then I'm going to have an allowance for doubtful accounts of $1 million. Okay. Let's look at letter C. Frontenac National Bank agrees to modify the terms of the note, indicating that Halvor does not have to pay any interest on the note over the 3-year period. Okay, so what exactly is going to be happening here? So this now becomes a 0 interest bearing note. And what we want to be doing is we're going to be using the market rate to go through and to essentially present value this back. However, as I'm thinking about this now and looking at the book solutions in conjunction with that, we're going to actually use stated rate on the note, because that's when the note, that's how the note was made up. So if FMB chooses to say, okay, the 5 million, and if I do the present value of $1, and if I do 3 periods at 10%, present value of $1, 3 periods at 10%, this is 0.75131. So the present value of the note payable is going to be 5 million times 0.75131, or 3,756,550. So over here for part C, for FMB, FMB is going to have a bad debt expense. So my bad debt expense here is going to be the difference between the carrying value or the face value of the note payable less the future payments I'm going to be receiving. In this case, it's just the interest, or excuse me, basically it's just going to be the principal amount being paid in 3 years. So that's going to be 1,243,450, and I'm going to have my allowance for doubtful accounts of 1,243,400. Okay. So when we look at the books of Halvor, no entry is needed because the aggregate cash flow equals the carrying amount. So in this case here, we're paying out, remember, we look at this on an undiscounted basis. Halvor is still going to have to pay 5 million, and that's what they're going to be going through and paying. So again, the carrying amount is the aggregate cash flows, the principal is equal to the carrying amount. So there's no entry that's going to be needed. Rather, there will be a disclosure. Okay, so FMB agrees to reduce the principal balance due to 4,166,67 and require interest only in the second and third year at a rate of 10%. Okay, so if the principal balance is going to be 4,166,667, we're probably going to have an issue here. So we've got 4,166,667. So this is going to be present value of $1, 3 periods at 10%. So right over here, we're going to use that same factor, or 0.75131. For this one, though, we also have something that's also happening at the same time. They're getting interest payments in year 2 and in year 3. So what I'm going to do is that if the interest payment is 10%, so this is going to be interest payment year 2. So for this, because it's happening 2 years from now, this is going to be discounted at 2 periods at 10%. My interest payment year 3, it's going to be the same amount, and I'm going to use the same present value factor over here. Okay, so I go to present value of $1. 2 periods at 10% is 0.82645. Okay, so the total value of the future cash flows is going to be $3,787,858.64. The original amount of the note, or of the note receivable, is $5 million. So what Hoover is going to be doing here is they're going to be at a loss or bad debt expense of $1,212,200. Now, what's of interest to me on this is that, let's see here. Okay. Okay. Wow, they did it some, okay, so they did it some crazy way, but we're off by about 31 bucks, but that's fine. So over here, so it's asking me, so what would they go through and do over here? So you would have a bad debt expense, $1,212,141, and then you'd be crediting the allowance for doubtful accounts for that same amount. Okay. So for Hoover, what's happening with Hoover is right over here. Hoover is basically the amount that they owe is basically Hoover's note payable. So again, right over here, this is what is happening with Frontier or Frontier National Bank. So they're going to have this. But for Hoover, we look at the undiscounted cash flows. So they're going to be paying $416,666.70 twice. And then they're also going to be paying a principal amount of $4,166,67. Since this is equal essentially to the same amount of the principal, there's going to be no entry is needed because the aggregate cash flows equal the carrying amount of the note. Okay, so that is problem 1413. And I want to thank you for joining me here today. Most importantly, I want to thank Wiley for their solutions and also for allowing me to share these with you. So please don't forget to like and subscribe. If you would like to see other solutions, please feel free to ask for them in the comments below. Have a great one.